Welcome to Catalyst. I'm Madison Mills, 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the outlook for stocks as tariffs and weakening data prompt analysts to cut their forecasts on the market. Plus, we'll break down the economic impact of tariffs from the labor market to inflation. And amid the uncertainty, we'll sit down with the billionaire founder of Kind Bars to talk where he's putting money to work. Half hour into the start of your U.S. trading day, let's get you a check on the major averages here. More red on your screen, but actually seeing a little bit of a recovery from the worst of the morning selling. You got your S&P 500 just below the flat line, your tech-heavy NASDAQ off about 0.1%. Let's see if yields are still moving to the upside here. You've got your 10-year yield up about 2 basis points, steadily above that 435 level. Seeing yields continue to climb, perhaps the bond market being a little bit concerned about the inflation picture moving forward off the back of these tariff announcements. But finally, we do want to take a look at auto stocks amid the tariff news. You've got GM, Ford, and Stellantis all in the red. Meantime, Tesla and Rivian seen as potentially being able to withstand the impact of these tariffs given some of their production and also Tesla's relationship with the White House. You've got those stocks moving into the green this morning. I believe GM having its worst sell-off this morning since the beginning of the year here. Well, I want to bring in Mark Malek. He is the Chief Investment Officer at Siebert. That's an investment firm with $19 billion in assets under management. He's going to join me as my guest co-host for the hour. Mark, great to have you in studio again.
Great to be here.
Thank you for being here. So let's talk about the market action. It seems to me like, yes, we are having a sell-off in these auto stocks, but it seems like the major averages overall are kind of ignoring the risk of tariffs at this moment. Do you agree with that? And do you think the market will potentially be caught offsides on April 2nd as a result?
Yeah, I think there's been so much talk leading up to this. I think everyone at this point is penciling in a worst case scenario for next week. So I think the markets, it's not surprisingly that the markets are sort of looking beyond today's news to maybe next week's news. But the interesting thing is if next week they get what they want, you may end up with a situation where it's going to be like, sell the news kind of situation, right? So markets are sort of on the rumor that it may not be so bad next week. They're buying. Next week when they hear it may not be so bad, maybe they're going to be selling. So I'm looking for some more downside action next week.
And how do you find conviction in this environment? We mentioned you've got that $19 billion in assets under management into your intro here. Where are you finding the ability to be convicted when there is so much uncertainty?
Yeah, that's a fantastic question. It's very, very hard to find conviction at this point. But I always, we're more long-term oriented, right? So if we're focusing on the long run, we look at this period now as just it's a lot of noise actually, but this is an opportunity to buy when we have these types of situations, because if you're buying on strong fundamentals, once we get through this stage of unknowns becomes knowns, I think then the fundamentals will take over again. So focusing on the future, just like you're on rough seas and you want to avoid getting seasick, you got to focus on the horizon.
And I remember the last time you came on, you told me something that really stood out to me, that if you believed in a stock enough to buy it, you should still believe in it even when it's seen some tough times, right?
That's correct, right? If the thesis doesn't change,
right,
then there's no reason to act, right? And so the thesis has somewhat changed, but for most stocks, right? So all the competitive stocks that we're looking at, they're all under the same type of pressure. So the question is which ones are going to be able to weather these storms best? And if you're selecting based on strong management and strong fundamentals, these stocks should hold. And many of the stocks that were very favored stocks early on, which have suffered recently, they still have very, very strong fundamentals, and the thesis is still there for a lot of these stocks. So it's just about getting that conviction, digging deep and knuckling down and, just sort of riding this through at this point.
Can you give us a little more insight into what you're buying right now?
Yeah, so in terms of growth, the story still remains the same. We see the biggest amount of growth in tech around the AI ecosystem. Obviously, not all stocks are created the same, but more generally, we still like that in terms of growth. We see some opportunity in financials, right? Because financials became a little bit more cheap recently. And the stronger ones, the ones that we liked before, that we were sort of reticent to pick up because they were picking up too much in value, we're looking for some value there. it's going to be interesting to see how their earnings come out. So we're going to watch that very carefully. So based on earnings, we kind of are looking around fundamentals. And of course, healthcare has some potential opportunities. Again, it's a very big sector, but within the sector, we think there might be some opportunities because there's some value there with the opportunity for growth.
Are you looking outside of the U.S. at all?
That's a little bit of a challenge. I think that horse has already left the barn.
Yeah.
I think they're trying to figure out over there this big spend that's going to happen in terms of defense, and I think that the market reacted appropriately very quickly. And I think at this stage, we're looking at stocks that we didn't love 2 years ago that are now trading higher, have traded higher. So stocks with not great growth prospects are richer now. So unfortunately, I have to watch this one from the sidelines.
Yeah, at this point, European financial stocks currently more expensive on a valuation basis than U.S. tech stocks, which has been a fascinating dynamic to watch. All right, Mark, you're going to stick with us for the hour. We're going to have a lot more questions for you, but I do want to get over to our next segment here. Barclays is the latest bank to cut its S&P 500 price target as tariffs and weakening economic data weigh on markets. Our very own Josh Schaefer just got off a call with the strategist behind Barclays' target cut, and he joins us now with the takeaways. Josh, Venu Krishna, what do you have to say?
Yeah, essentially, Venu's take was that their earnings target is just a lot lower now, right? And so how do you get to lower earnings, right? What's sort of weighing on it? You mentioned off the top there, Maddie, definitely tariffs and sort of a higher expected tariff rate now than maybe what the firm thought coming into the year, right? And so you start to factor that in on how it's going to weigh on different sectors. For example, they downgraded consumer discretionary, right? A sector that is obviously very exposed potentially to tariffs. You also tie in just a slower economic growth forecast. Their economics team now forecasting GDP at less than 1%. At 0.7. It's just a significant it's pretty low, right? 0.7. Now, you did point out not necessarily, there's not a direct correlation there between you can have a sluggish GDP environment and still a pretty solid earnings environment, but right now you certainly have that uncertainty overhang, and that seemed to be kind of the key takeaway for where we slide from. Does it go above 5,900 or below 5,900? Really kind of depends on they're putting in about a 15% effective tariff rate. So if we get a higher effective tariff rate than that, then that's probably worse for stocks, worse for the economy. Also, B, when do we actually know what the tariffs are and how long does that sort of last? And that's something I've sort of been thinking about a lot, Mark, is just essentially how much does the tariff rate matter versus the uncertainty in us actually finding an answer? And I'm sort of curious how you're digesting that difference, right? Is it the number that we want to know? Like, does the number matter the most, or is it just having some sort of answer that's going to maybe help out the market here?
Yeah, that's a great question again, right? It's a little of both, right? So the uncertainty is definitely dictating where the market's going and how we're reacting today. Knowing the number is paramount, right? Yeah. Because we all want to go back to our desks, want to get the slide rules out and figure out, is it a 15%? Or is it 20%? Or is it 18%? Once we can do that, then we can actually handicap these stocks and say, hey, is there value here? Are they above their target, below their target? So there's volatility, which makes it that much more difficult to get into the market, and not knowing what that actual number is also a big factor. So if I had my druthers, I'd have no tariffs, right? But if I had ultimately got what I want, just rip the Band-Aid off, tell us what it's going to be, then let us go back and figure out what it is and who it's going to impact and how we can adjust appropriately.
And I think the one thing that stands out too is it just feels like we got a date with April 2nd, right? Trump is calling it Liberation Day, so we have like this fancy day to sort of peg all of this to. I don't know how you guys feel, but it feels like the more people I talk to, it doesn't seem like we're getting a lot of solution maybe next week, right? When you think about the tit for tat nature of tariffs, how do other countries reciprocate, it just feels like the uncertainty overhang isn't really leaving the market next week or isn't expected to leave the market next week, and sort of maybe just continues to keep us in this tight trading range where it's tough to figure out where we're going for probably another month at least, right? A little bit longer.
And then on top of that, you have all of this euphoria about the second half of the year that we'll get tax cuts and that's going to be positive for the market. But also, are we actually going to get more tax cuts? Maybe we'll just get an extension of what we've already had. And will that actually be enough to be a positive catalyst for the market? One thing that I was interested in Venu's commentary from Barclays is that he did sort of rule out a recession, which seems like a slight bullish light in the tunnel of the darkness of him cutting his S&P 500 price target. Do you think that we are in the clear of these recession calls, at least short term? I keep waiting to see.
Are you trying to make me make a recession call, Maddie?
I guess I'm just curious, like, what's it going to take? And Mark, feel free to weigh in on this too. But what's it going to take? Is it the hard data falling over? Like, what is it?
Yeah, I mean, I think the issue with straight up calling for a recession right now, or the issue it seems some economists are finding for, would be your hard data point. Your unemployment rate right now is 4.1%, right? And it has not been aggressively rising over the last several months. Last month, it came up 0.1 of a percentage point. It's not like we are seeing initial jobless claims were out this morning. They were basically flat again from the week prior, right? When you look at the hard data, you're not getting that story. The recession call would sort of come from we have a lot of conviction in what tariffs are going to do to the economy, what this uncertainty overhang is going to do to the economy, and that's going to spark your recession. I think it's just a tough call to sort of make right now when you don't really know. A final thing I'll throw in, and I'm curious perhaps what Mark thinks about this just overall, would be one thing economists keep talking about is sort of downside risk to the stock market being a potential catalyst for a recession. So when you think about the wealth effect that we've had over the last several years, over 50% of spending, or about 50% of US consumer spending, comes from the top 10% of income growers, right? The most rich people spend the most in the US. So if you were to take their equity value down 20%, go into a bear market, then maybe that's what slows spending. But it seems like after the last few years, it's tough to pin down what's going to slow down the U.S. consumer enough.
Yeah, that's another great question. Thank you. What I'm watching is the consumption numbers, right? Because those are the ones you can't argue with those numbers, right? When consumption starts to slow down, we have a problem, a real problem, no matter how you define recession, right? Because really it's 2/3 of GDP. So if we see people starting to actually spend less, we are seeing a deceleration at this point. We've got to watch it closely. But you mentioned the stock market, which is, I agree that there's definitely that wealth effect. But it's interesting, there's a lot of academic studies out there that show that even people who don't own stocks pull back on their spending when they hear that the stock market is performing badly, right? Because it's sort of an indicator that affects consumer sentiment. So, that just makes the job that we have even harder, right? Because we affect all the people that even don't have stocks, right? So, clearly we'd like to see the market hold up. The market has held up, but we haven't seen those hard numbers yet. We're going to watch them closely.
Jobs report next Friday.
Yeah?
There we go.
Plenty of data to take a look at these days, especially. Josh, thank you so much as always. Really great reporting there. Thank you. Turning now to President Trump's tariff policies, with a slew of levies going into effect next week. Trump announcing 25% tariffs on cars made outside of the U.S. will be imposed on April 3rd. That's one day after what Trump is calling Liberation Day, April 2nd, when reciprocal tariffs, resumption of the Canada-Mexico tariffs, as well as levies on countries importing Venezuelan oil will all kick in. Our next guest calling the tariff policies a, quote, recipe for recession. We've got Doug Holtz-Eakin, former director of the Congressional Budget Office, here with us now. Doug, I love speaking with you. Talk to me about this recession call. How do you see that happening?
Well, I think as was just mentioned by your reporter, there isn't hard data yet that says we're in a recession. So it's not now, but everybody has marked down their forecasts to something that looks like 1% or lower, and we haven't seen the real impact of tariffs yet. We haven't seen the imposition of the reciprocal tariffs and how large they are. I think people are underestimating the damage that comes from 25% tariffs on Canada and Mexico. This is a unified economic entity in North America. Ripping it apart with that tariff policy will do tremendous damage to all three economies. I think that's the one that really hasn't been priced correctly. And, I think it would be just a fundamental policy error for the president to go there.
Doug, the market is still really clinging to any hope of a negotiation and of a rollback of every single tariff that gets announced. Do you think that the market is right in holding on to that hope?
No. I think there are different kinds of tariffs. If you look at autos, pharmaceuticals, lumber, chips, steel, aluminum, those are national security related tariffs in the president's view. The purpose is to get domestic manufacturing and to move the factories onshore. Those are permanent, I think, from the perspective of the Trump administration. Canada and Mexico, maybe there's a negotiation there that makes those go away, but the president has yet to enunciate a goal. Like, what is it that he's trying to accomplish with those tariffs? What would be a successful negotiation? So a little wait and see there. And as I said, they're very damaging. The reciprocal tariffs, country by country, you might go around and get a deal to lower those tariffs, but that's a long process. So I think it would be a mistake to think this is a transitory, blip on the tariff front. They're here, they're damaging, and they're going to have an impact on the U.S. economy.
Yeah, I'm curious. What are your thoughts in terms of how the mechanic works? Right? Does it start from the inflationary effects of those tariffs, so consumers will stop buying, or is it going to be first? Is it going to sort of hit the sort of corporate world that's going to struggle with margin compression, and then they might sort of slow down their spending and their hiring and all that type of stuff? These are the areas where we historically have been the catalysts, if you like, for these recessions. How are you seeing that?
Well, a traditional business cycle in the United States starts with a downturn in business fixed investment. The only exception to that's the pandemic. And so I'd watch the business sector very carefully. I think the uncertainty is already taking a toll. We got a pretty weak capital goods order for February. Ex transportation and defense was down 0.3%. That's a warning sign in my view. I'd keep a close eye on the business community. It's not going to help when households, see the market go down and get cautious. We've seen sentiment decline, and if they get a big price increase on a sensitive category like gasoline, then you've got both the business and the household sector heading in the same direction. That's a recession.
Doug, let's talk about another challenge in the market right now that you're very familiar with, coming from SIBO yourself, and it is the debt limit. We had an update from SIBO calling the ex-date to come in August, a little bit sooner than previously anticipated. To what extent do you foresee what the market is sort of hoping for right now happening, which is that we do get these tax cuts, and that is looped into the reconciliation bill, which also allows for an increase in the debt limit, just given that we still have a lot of congressional debt hawks?
I think tying those together is a risky move, personally. There's no penalty for moving the debt limit early. It's simply, you take off the table any sort of showdown over the debt limit. You take off the table any financial volatility that comes with tiptoeing up to the ex-date. Tying it into the reconciliation process, where you have a really tough tax negotiation that's going to take what I think is most of the year, doesn't seem like a sensible strategy. You're holding your domestic policy agenda hostage to the ex-date, and you're holding the debt limit hostage to how the tax negotiations go. I'd separate them, take care of the debt limit. That's business that has to happen, and all parties know that, and then move on to really getting the tax bill right.
Doug, I'm curious about your thoughts in terms of raising that debt limit and increasing the size of the debt. Clearly we need to figure out ways to mind our money better. We all understand the long-term benefits of doing that, but there could be some short-term challenges getting there, right? Because we still have to service our existing debt, and interest rates are very high, and the administration has made it very clear that they want to see lower, longer maturity yields, right? For so many reasons, the least of which is it's really holding back certain sectors of our economy. I'm curious on your thoughts on expanding debt and the impact on longer term or long maturity debt yields, right? Is there going to be a push upward, or is it going to be more difficult or challenging for the administration to bring those longer yields down?
Well, I think, first of all, you raise the debt limit because those are past bills already incurred, and that should be separated from taking care of business on the unsustainable fiscal trajectory. And to do that, to really get that under control, you have to do something the administration's been unwilling to do. You have to touch Social Security, Medicare, Medicaid, the big entitlement spending programs. Medicare and Social Security are by themselves more than 1/2 of all non-interest spending over the next 10 years. If you want to control the growth of deficits and debt, you have to come to terms with the spending side of the equation, and they haven't. So I think markets are going to look at that. If they become convinced that no one will take on the mismatch between spending and revenue, they'll be increasingly concerned about the U.S., and we'll see that at longer yields. But remember, there's no quicker way to get interest rates down than to have a recession. So I think in the near term, that's the bigger risk.
All right, Doug, thank you so much for laying out those risks for us. Really appreciate it. The global trade war escalating. President Trump announcing 25% tariffs on cars and car parts not made in America, and threatening more tariffs on the EU and Canada if they work together against the U.S. Markets weighing the potential impact to the U.S. and the global economy off the back of these tariff announcements. Joining us with more, AJ Rajadesk. He's Barclays Global Chairman of Research. AJ, great to have you on here. Talk to me about how the market is digesting these latest rounds of tariff announcements. Do you think the market is ignoring a bigger risk come April 2nd?
Yes. And you're absolutely right. The market so far has been far more sanguine than we expected, even after the pullback in equities that we got in the first quarter, and especially overnight. I mean, the Mexican peso has really not moved very much. 5% of Mexican GDP is finished autos exported to the United States. If there's an actual 25% tariff going on that, maybe it gets taken out. But right now, that's what the president says, and the market does not seem to be reacting to it at all. And I'm not quite sure why. Maybe it is that the market thinks that this is the worst of it, that the reciprocal tariffs will be a nothing burger. Remember, the president did say that he was not going to impose reciprocal tariffs that necessarily included all non-tariff measures. So, that's the difference, Madison, between 2% and 20% tariffs on April 2nd. But yes, right now the market is very sanguine.
So what do you think investors should be doing right now? What would make more sense to you on the tape?
Be as defensive as possible, honestly. I know this is not a great message to have, but we have pulled back in equities, but we've only pulled back about 6 to 7% on the S&P 500. As you mentioned earlier in your forecast, we have a 5,900 call on the S&P. That is in our baseline. But our baseline does not assume the worst case on tariffs. If you get a worst case, you do get a US recession, and then our bear case is 4,400 on the S&P. That's a long ways to go lower. So we are as defensive as I can remember in the last 2.5 years. That's what we are telling clients.
Yeah, AJ, you mentioned defensive maneuvers. That sort of makes sense. A lot of us on the street are struggling to find where we can find some shelter in this market. I'd be curious to know what your thoughts are. Where we should be looking for that defense at this point, taking money off the table or what have you.
So financials we like, including in the US, but also in the euro area, even now. I mean, I know European financials had a great 2024, but I think there's still room to go. We like healthcare in the United States. We generally think the big 6 tech firms are going to have pretty good earnings. The earnings are going to hold up. They are much cheaper. If you remember, they were trading at a 31, 32, 12-month forward multiple. They are now running at closer to 25, and they're starting to get interesting. But the S&P 493, at an 18 multiple for 12-month forward earnings still looks too expensive. Europe's catch-up, we think, is largely done. China tech, we think, still might have a little more bit of room to run. But yeah, you're starting to run out of places to hide. For a while, I think it's going to be cash and front-end US rates.
Thank you for that. Jay, final minute. Can you tell me a little bit, you mentioned healthcare. Within the healthcare sector, it's a very broad sector. Which areas within the healthcare sector would you look at right now? Because it's so different from one end to the other.
So, what we are telling investors is to stay away from sectors that have not overreacted to the RFK nomination and confirmation. But there's a bunch of sectors within healthcare that have. We don't think there's actual policy changes on that front that are going to be that aggressive. But more importantly, it does tend to be one of the sectors. Even if you go into a pullback in consumption, you don't get a big pushback on pulling back on spending on that front. And even that, you said it's a big sector, it is a big sector, but overall we still think that sector as a whole is going to be fine.
At what point, AJ, does the totality of the uncertainty and some of the softness we're seeing in the economic data make you call for a recession?
The thing to watch is the US savings rate. That is the Achilles heel for the US economy. It is extraordinarily low. It's been low for the last 3.5 years. For context, it's between 4 to 4.5% now. 2019, the last full year before COVID, when the jobless rate was lower than it is right now, the savings rate averaged 7%. Now, if you get a steady drumbeat of policy uncertainty, no job cuts, actual tariffs, the equity markets pulling back, it's not crazy for that to go from 4.5 to say 6.5. But 70% of the economy is consumption. If the savings rate goes up 2 points, consumption pulls back 2 points. Mm-hmm. That's 150 basis points of growth gone like that. That, I think, is the thing that we don't think it comes to that. We think we will avoid a recession. Josh was on my call, a little earlier when he was talking to Venu. So that is the call. But the risks are tilted to the downside if April 2nd ends up being worse than expected.
All right, AJ, really great overview for our investor audience. Thank you so much for your time this morning. Appreciate it. We're going to have all your markets action ahead, so stick around for more right here on Catalysts.
When it comes to predicting and measuring market volatility, there's more than one way to gauge pressure across asset classes. And today we're taking a look at the volatility spectrum featuring a VIX for every occasion. I'm Jared Blickery, host of Stocks in Translation. And let's start out with the original, the OG. That would be the SIBO Volatility Index, the VIX itself. This is simply a real-time measure of expected 30-day volatility in the S&P 500 based on index options pricing. So you take all the S&P 500 index options out there, and it's actually 24 to 37 days. Just learned that with 30 days in the middle. And that gives you an idea of implied volatility. And implied means it's just an expectation of the future. And that stands opposite what we have in the past, and that is realized volatility. But we're going to be looking at what the options market is trying to say about different assets. And so we're starting with stocks here. This is the S&P 500 VIX, and it's important to say what the VIX is not. I sat down with Steve Sosnick of Interactive Brokers yesterday for taping another episode of Stocks in Translation, and I finally got it. He's been hammering this home for years. The VIX is not necessarily a fear gauge. A lot of times it rises when there is fear in the market, so that's easy to say. That's an easy conclusion to come to, but not always the case. More accurately, it is institutional positioning under pressure. And a lot of institutions are the most active in this market, these longer dated options in the S&P 500. And really the retail market is not aimed at that length. It's really more of a same day or 1 week out kind of situation. So we're measuring what the pros are having to do when they have to scramble. And this is the VIX chart that we've seen year to date. And we just saw those institutions really scrambling. And we got a high of almost 30 here. It looks like about 28 on the chart. And then we came down and we have just kind of lifted off a little bit again. But this easing in pressure here has coincided with the rise in stocks. And I think it's instructive to compare this most recent spike with some of the others that we've gone throughout history. This one in December, almost all of this move was made in one day. You compare that with this spike here, this was made over 2 weeks. So it's a different character. Institutions have had to do a lot more repositioning, and that probably speaks to the tariff situation and the likelihood that we are going to have more elevated volatility this year. We're not seeing it just kind of wash away in 1 or 2 days the way we had in the past. So let's move on now. I want to talk about the bond market here, and we'll get a read on that with the MOVE Index. This is the ICE B of A MOVE Index. Ticker on Yahoo Finance site is #MOVE. This just tracks expected volatility in U.S. Treasury yields using options on Treasury futures. So that's the 10-year T-note futures, 30-year futures in the T-bonds. And MOVE is really interesting to me because bond market is actually more important to risk markets than the S&P 500. It's a more accurate gauge. Here's the ICE B of A MOVE Index, and I'll put some lines on here so you can see it a little bit better. This is a 6-month look. I'll put it on a year to date so you can see this spike a little bit better, but not quite as dramatic as the VIX. And as you can see here, it has come down, and whereas the VIX is still lifting off, MOVE Index has come back down. The bond market is quite comfortable, or is more comfortable with the current situation than the stock market. And so that's actually a boon for risk markets. Now, if I show you the 5-year history of the MOVE Index, just real quickly, it looks a lot different than the VIX. So this is important because it's just another nicer read on what's happening in the market, just kind of a different point of view. So I like to look at them in combination. We can also take a look at, here we go, we can also take a look at gold volatility. And yes, there is a gold VIX. And what's interesting about this, and this is based on gold options, options on gold futures, and again, it's a 30-day look. What's interesting about the gold VIX is it tends to rise as gold price is rising. That is the opposite of what you're seeing in stocks, because usually as stocks rise, you're seeing the VIX calm down because there's less fear in the market because everybody's happy about those record highs. But in gold, a lot of times gold is surging because there's turbulence in the market. People pile into call options on gold, and this causes implied volatility, those expectations, to rise. So gold volatility and gold prices tend to move together. And if we take a look at the gold chart here, the gold VIX, and I'll put some lines on there. There we go. Let me put a year to date so we can see the most recent move. Gold has been hitting, I think, 16 record highs this year, and it's within spitting distance of another one, yet volatility has been dropping recently. So maybe gold isn't quite the safe haven. Maybe the run is kind of petering out here. I don't want to read too much into the price action, but I do think it is worth considering. And then finally here, I want to highlight the VIX of the VIX. And this is something that tends to blow people's minds. You can actually take VIX futures, you can look at the options on them, and you can make an impression, you can make a guess about implied volatility in the VIX market itself. And so this is the VVIX. And on the Yahoo Finance site, you have a little caret before. And I'll show you what's happening in the VVIX, because that's really interesting too. On that latest spike, when we were looking at, and this is kind of like that spike we were seeing in the normal VIX here, well, it came down to a lower level, level that we haven't seen this year at all. And while it's come up a little bit, it's still at these depressed levels. So traders might not be expecting as much volatility in the VIX itself. So all of this put together tells me that this is kind of risk on. It's not a screaming buy signal, but it's lending support to the idea that we do have some risk kind of abating here. Nevertheless, we will probably have elevated volatility going forward until we see some different signs and patterns. Tune into more Stocks in Translation for more market decoding deep dives and new episodes Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. Really appreciate it. Coming up, we're taking a look at some of today's trending tickers. Alibaba debuting a new AI model. Investors also keeping a close eye on Lululemon's guidance. We'll dive into all that and more next on Catalysts. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. First up, Alibaba releasing a new AI model in its Qwen series that can run on phones and laptops. The company saying it can process text, pictures, audio, and videos while generating real-time text and natural speech responses. Alibaba expecting the new model to be used to build AI agents that could help a visually impaired person navigate their environment with real-time audio descriptions. Mark Malek still with me to discuss. You got the ADRs here up about 3.5% for Baba. What do you make of Baba right now? Do you think the run-up that we've seen in the stock indicates that it's a little bit too expensive, or is there still opportunity for investors who believe in the mission?
Yeah, I think it is a little bit expensive here, and I think this news is interesting, but really it just represents a progression of technology, right? Mm-hmm. It's not necessarily in the big AI play that we all want to sort of attribute it to. They're finding ways of putting AI shocker into laptops and handsets. It's a completely different play than we've been talking about more recently. So it's a progression, and in terms of where the company is now, in terms of the guidance of the company, the outlook for the company, the challenges with a company like that is because it's such a broad company, there's so much we don't know about the company, and of course there's the government influence on the company. It's very hard to make an investment thesis on a company like that. But we have seen it run up quite a bit, and we've seen it run up on pretty good news, but the question is what does it all mean? How is that going to translate? I think if we put the same level of scrutiny that we're putting in the domestic AI stocks on Alibaba, we might come up with a different picture.
No, it's such a great point, especially about the lack of transparency there. I wonder how that plays into your thoughts on this question about whether or not the China AI names are indicative that the U.S. AI stocks and tech names in general are spending too much money on AI and that it's not actually worth it. You're not going to get the bang for your buck on that ROI moving forward. How are you viewing that discussion?
Yeah, I think as we talked about last time I was here, the progression of AI, the growing of the market, the competition is extremely healthy for all companies. So even if you have a company in China that has a more efficient way of building models, that's great. That just means we're going to get more power out of the same infrastructure that we're building. So you're not going to see people saying, oh, okay, they have a more efficient way. We don't want to use that. We're going to use the same power we've already built, the same infrastructure with those more efficient models. Yeah. So in terms of the infrastructure investment, that is very much alive. And it's for us consumers consumers,
Yeah.
it's a very much good thing because we're just going to have better AI.
Right.
More competition is good for us.
Well, this dovetails perfectly into our next trending ticker I want to talk to you about here. Microsoft abandoning data center projects in the US and Europe due to oversupply. According to TD Cowen analysts, the projects would have amounted to a capacity of about 2 gigawatts of electricity. Microsoft saying it remains on track to spend $80 billion in capex building out AI data centers in its fiscal year that ends in June. So we should mention TD Cowen has already come out with this call that there's too much oversupply with these data centers, adding more evidence to this. Does this change your view?
No, I think that's great. I'm saying kudos to Microsoft, right? Because they still have to manage a company, and you know the thought is let's throw everything at this because we don't want to miss this great opportunity. And of course we expect that and we applaud that initially. But now it's time, now that we're all getting a much better picture of what this is going to look like, hey, that's a solid management decision, right? So I don't think it's bad for technology, the ecosystem. I think it's just they're doing smart management. That's why we like companies like Microsoft, because they have good management and they're tweaking it. That doesn't mean they're going to tweak it up at some point. But at this point, they're probably like laying their cards out and sort of making a more informed decision that we would hope that they would make.
Really great overview, Mark. Thank you so much for that. Appreciate it. Coming up, we're going to be talking to an analyst who sees a connection between Trump's auto tariffs and the unsteady geopolitical landscape. We'll be back with that next. President Trump is set to impose tariffs on the automotive sector starting next week, the latest addition to the sweeping reciprocal tariffs he is calling Liberation Day. But the real goal of tariffs may be more about national security and less about fairness, according to our next guest. I want to bring Terry Wisman. He's Macquarie Group's global strategist. Terry, thank you so much for joining us. Talk to me about the clarity and the thesis that you have behind the goal from the Trump administration on tariffs.
Well, there are different kinds of tariffs. First of all, there are the reciprocal tariffs that we may see imposed next week. And those really are a response to perceived unfairness in the international trade system. I think the administration perceives other countries to have plenty of tariff and non-tariff barriers to trade that impede a level playing field for the U.S. But what we're talking about this morning are these industrial tariffs. And we've seen these already. The auto tariffs are not the newest. They're the newest industrial tariff, but they follow on the steel tariffs and the aluminum tariffs, and we may even get pharmaceutical product tariffs down the road. But why are these separate? Because these are not really intended to level the playing field so much. What they really are intended to do, at least in the eyes of the administration in the US, is to help rebuild the so-called defense industrial base of the US. There's a perception on the part of the administration that without a very large manufacturing base present in the U.S. and manufacturing capacity, we're putting the U.S. at effectively at a disadvantage in the context of a very fraught geopolitical environment where there are a lot of conflicts. There may be a lot of conflicts in the future. You don't want to have the U.S. be the global protector, but at the same time have its hands tied behind its back with regard to its capacity and ability to fight the next war if that happens.
Yeah, so Terry, I have a question for you on that. So it's clear that the goals are very noble ones in terms of the strategic benefits of creating this sort of tariff system. The challenge I think that I have with it is that we're doing near-term measures which are going to take many years to actually play out, right? So right now we're getting, which I'll call, for lack of a better word, a little bit of pain, which is fine, but the potential gains, if we can even see them, they may exceed the term of this president and possibly even the next one. And you know how the political pendulum swings, that it could easily swing the other way, and a lot of this pain will be for nothing because a lot of this stuff will sort of be reversed by a future, let's call it, administration. So I was curious on your thoughts of that, and also, are there also other ways that you perceive that we can gain that strategic benefit without putting these tariffs, essentially putting the pain on our domestic companies right here?
Yeah, well, we're certainly putting the pain on our own auto companies. If you judge by the performance of their stocks yesterday, the prospect that their costs might go up because they have to source their materials in the U.S. as opposed to outside the U.S. parts, for example, is in fact putting the pain on those companies. And you're absolutely right. There are maybe better ways to address the problem of the hollowing out of the defense industrial base in the U.S. than to just put on tariffs on other countries. One way to do it is through the tax system, which is usually the best way that countries go about and public policymakers go about conducting industrial policy. So, for example, in the next tax bill that comes out of the U.S., you could have a clause, the introduction of a measure, whereby if you purchase a car in the U.S. as a U.S. Resident and you finance it, that you will be able to deduct the interest payments, but only for cars that are built in the U.S., where the content is 100% U.S. Well, that would be a huge incentive for the customer to buy U.S.-made cars, obviously. And of course, it would cause capacity to come to the U.S. organically without the need for tariffs. Right. So there's clearly other ways. And I don't necessarily believe that tariffs are the best way to bring that capacity back to the U.S. As far as the long-range considerations here, every journey begins with a step. And although it's true that the next administration may not approach the resuscitation, if you will, of the defense industrial base in the U.S. the same way that President Trump is doing so. Keep in mind, there were certain things that Trump did in his first term that were not overturned by the Biden administration, including those tariffs on China. So it's very possible, and I think the administration is counting on the prospect by the time that 4 years roll around, there'll be enough advancement with regard to this policy agenda that it will be very difficult for the next administration to turn things around or remove them.
All right, we got to leave it there, Terry. Thank you so much for joining us, Terry Weisberg.
My pleasure.
Fantastic note. Thank you. Coming up, the state of deal making with the founder of investment platform Camino Partners next. OpenAI is close to securing $40 billion in a new funding round led by SoftBank Group. That's according to reporting from Bloomberg. Incomplete, the funding round would be the largest in history based on data from PitchBook and would nearly double OpenAI's valuation to $300 billion. Investors in this latest round include Peter Thiel's Founders Fund, Magnetar Capital, Coatue Management, and Altimeter Capital Management as well. For its part, SoftBank will reportedly invest an initial $7.5 billion and more than $22 billion later this year. In comparison, Microsoft has invested roughly $13 billion in the ChatGPT developer. Let's stick with the macro investing environment here. Camino Partners, an investment platform focused on longevity, announcing new investments, including Barry's Bootcamp, Well Labs Plus, and home healthcare provider network LiveWell. Joining Camino's other investments in businesses that include publicly traded quick service restaurant Cava. Here now to discuss more, we got Daniel Lubetsky. He's Camino Partners founder, also the founder of Kind Snacks, which he sold to candy maker Mars in 2020 for $5 billion. Daniel, great to have you on here. I'm really excited to talk to you about your investment thesis on the longevity space. But first, I just want to get your sense on how you're viewing the market right now. I'm sure you got a lot of family members asking you this. Our audience of investors want to know how someone like you is viewing the market, how you're finding certainty in your investment thesis given the volatility right now.
Just go to the fundamentals, Madison. I mean, when we launched Kind, we went through the financial crisis, through many other crises, and Kind grew triple digits every year for 10 years in a row. And if you find a good team, a good product, a good value proposition, they're going to stand the test of time. And in longevity space, all of us are living longer, hopefully. And everybody wants to have higher quality of life. So areas that can help us improve that, whether it's how to do better fitness, how to eat better, how to live better, how to have better connections with our health and wellness and the healthcare system. I think there's a ton of innovation happening in that space. And if you find the right propositions that are actually delivering to the consumer, that are not fads, that people can actually see that it's actually impacting their health and their well-being, I think those are the companies that are going to outperform.
And for retail investors listening, Daniel, walk me through your rubric for sussing out which companies to invest in. What tools could investors listening maybe steal from you in monitoring investment opportunities?
We'll have far smarter people than me figuring that out, but one of the things they look at is gross margins and making sure that people are actually paying for those products or services and that people are actually appreciating them and that they are continuing to reorder. One of the things that I found, Madison, when I started Kind is the first sale is actually the easiest sale. It's the return sales that really, really matter.
Yeah.
And same with subscriptions, same with reorder, same with any industry. Are people happy? Because you can fool one person once, but if you really, really want them to come back, they need to be really satisfied with the value proposition.
Yeah.
And they will pay for it if it's real. It's not going to be artificially sustained through promotions or companies whose margins are not actually able to cover the costs or services that they're providing, the goods or services they're providing.
Daniel, great breakdown. Since you mentioned gross margins, I'm curious how that plays into your thesis on AI in particular. There's been this question about whether the ROI for AI is really going to be there. Are people really going to pay up for ChatGPT? How do you think about that?
First of all, the changes that are going to happen through AI are very, very real. I was just last week at a BDT MSD conference with some of the smartest people in the space. And what I can tell you is that everybody's reporting about how massive the productivity gains are. And I do think it's going to help the entire market. I also will tell you this is not an area where I go directly because I'm not the smartest guy in that room. So I follow the people that are really smart there and invest in the best funds that really, really know how to discern who to invest in the AI space. But for companies like CPG companies and healthcare companies and every other tech companies, you do need to start figuring out how to leverage those tools so that you can become more productive, and it's actually going to have an impact on everybody. And everybody should just try to invest in the areas where they are the foremost expertise and where they are the smarter guy in the room. In our case, it's looking at health and wellness, at longevity, at consumer product goods, and figuring out how we can actually create sustainable positive impact that's scalable for consumers.
Daniel, real quick, a big fan of Kind, and clearly the landscape has changed a lot. We're talking about AI now and productivity tools, but you had great success over at Kind, and there's some things that are just timeless, and that's why I always am very focused on management. Give me the one thing that you took from your success over at Kind that is going to, make you successful in these great ventures that I see that you're investing in.
I think what made us outperform everybody at Kind was our culture and our values. We had the hardest working team, the smartest team, the most critical thinkers. We had a very open debate environment where people would engage in constructively tackling every question and debating with one another, which for that to be constructive and useful, people need to trust each other. People need to know that it's okay to challenge conventional wisdom and be rewarded for taking risks. And so we had an ownership mentality, we, not me mentality. And I think creating the right culture for your team to outperform is essential in any company.
Speaks to your leadership, Daniel. Thank you so much for making time with us. Please come back soon. Appreciate it.
Thank you, Madison. Thank you, Mark.
Coming up, we've got Wealth dedicated to all your personal finance needs. Brad Smith is going to have you for the next hour, so stay tuned for more.